All right, good afternoon, everybody. All right, those who are here, welcome to what is basically our last day of class. Right now, of course, yes, we will be having some sessions next. Oh, right. On that note, I have to let you know one time. So I believe I may have mentioned that my wife's grandfather passed away a couple days ago, right? Wednesday night, I believe it was, right? The funeral is set for Wednesday morning, 10 o'clock. I had a feeling that would happen, right? So I have to put these sessions on a different date. Okay, I am thinking I'm just gonna cancel my phone for people, or I could shift it to the evening on the Thursday, right? I'll send a poll in the chat to see what's more convenient, if it's these two sessions on the Thursday, or the two 4 to 6 sessions on Thursday and Friday. All right, so that with that out of the way, I just open up one more file on this computer, and then we could start starting. All right. Yeah, so I mean, these things happen. You just have to, I was thankful I had sessions available to be able to give you guys an option. Okay. Sorry. Yeah, like I said, I got a bit distracted. Of course, everybody now commenting and asking questions on videos. So many questions. A little interesting, you know. So there's catch my attention. All right, cool. That's good. Put that down. All right, where were we? There were we. Okay, cool. Right, yeah. And I think you guys have a multiple choice at some point. Yeah. Around here, right? Unit 2, right? So what I could do, according to what you guys have going on here, and I'll take a look. Oh, there's some. Oh, Joshua. Oh, Joshua present. Hey, good afternoon, Joshua. How you going? Good to have you on. All right. All right. So yeah, guys. So for the accounts unit 2 paper 1, the prep for that. Yeah, I could try to hand off the AdMat stuff. I don't know why I have these sessions here. These shouldn't be here because English B and PUB is that day. So I don't think many people are gonna come to those sessions. Yeah. So what I could do again, I could maybe kick out my phone fours here and here and host you all. I could put you all there. I could put you all there. I could even this one might be a bit difficult, but yeah, they have like 6 sessions after, and I could double up. I could triple up on the weekend. Right. So yeah, we could try. I could try to give you all maybe 6 sessions, max 8, but even that might be a little difficult to do. So we'll see. I'll send some, what you call it, some polls in the chat to see what days are amenable, convenient to everybody. Oh wait, so you guys have the papers 1 week apart? Wow. Okay. All right. Well, maybe I could hand off my AdMats classes to my assistant, and then I could do paper ones with you guys from all there. Yeah, because I could Saturday, Sunday I could do, if you're available, I could hand off AdMats to her, and then I could do some more stuff here, maybe even the Monday. But I had to see what exams you guys have going on between the 12th and the 15th, right? So yeah, let me send some polls in the chat, see who's doing what, and then we'll figure that out, right? But once again, the sessions that I had planned for the Wednesday, I can no longer do because of a funeral I have to attend, right? So I'm gonna put you guys tentatively for the the 4 to 6 and 6 to 8 sessions on the Thursday. What I had there? Oh no, yeah, forget that. Yeah, so no class here for me. All right, okay, guys. So without any further ado, let's start starting. Right. So this will kind of rounds off what we have to do for investment appraisal / capital budgeting. Okay. So yesterday we met the NPV, the net present value, which took into consideration what we call the time value of money. We said money, $100 today is worth more than $1 in the future. And if we getting cash flows in the future, we can't just add cash flows years apart and compare them to the initial investment, because we won't be comparing money or dollar values with the same purchasing power. So that's not correct to do. All right, because of the phenomenon of inflation. So we learned yesterday about the principle of compounding and discounting and how they work percentage-wise. So compounding is like growth. So if we invest $100 today at 10%, it'll grow by 10% every year. So not just $10, right? 10% of 100 is 10, then we add that 10 to the 100, get 110, etc. Right? So we could grow using compounding, and we could start at a value in the future and discount to find what that value is worth today. Right? So for example, if we want, let's say, $1 million by the time we retire, like for me, which is way nearer than y'all, right? The rate I go, and I probably can't retire until maybe 75 or 80 if I'm lucky. Anyhow, okay, so let's say I have 30 more years to go at a stretch, right? So if in 30 years I would like, let's say, $10 million, right? I need to know, well, how much should I invest today at what, and if I had an interest rate to get that. So what I would need to do is I would need to start with the 10 million and discount it, right? So we saw the discounting, right? And we also met on the previous day the payback period, which is how long it takes for a project to pay back its initial investment. How long until they get your money back and then start making profit. But again, with payback period, is cash flow, not profit, right? But I mean, I think there is a concept such as cash profit or surplus cash, right? Anyhow, so discounted payback period. So this investment appraisal technique uses discounted cash flows to calculate the payback period of an investment, all right? So the example I'm going to give, right, we have an IO, initial investment of 100,000. The annual net cash flows, 40,000 per year. The time is 4 years, and the rate is 10%, right? So the net cash flow, so basically the setup here is like what we had yesterday for the NPV, except we're not going to be subtracting the initial investment below here. We actually have to kind of combine this particular layout with the payback period layout, which is where we have the balance, the amount we initially invested there, right? And we're going to subtract the present values as we go down until we've paid back for the entire thing, or until we have to calculate how many weeks or months in the final year, all right? Okay, so we're going to start off by putting the 40,000 per year here, right? Now, again, this column is not necessary. I just like to show these figures because of the way my mind likes mathematical things and precise values in certain areas, right? Now, the PVIF stands for present value interest factor. It is the value factor by which we're going to multiply the cash flow to bring it to today's value, right? Is the figure by which we multiply it to discount it so that the purchasing power is equivalent to the purchasing power of the money of the initial investment, right? Okay, so we know how this looks. So it's equal to 1 plus the interest rate, right? And we raise it to the power of negative that, right? Oh, hold on. So let's leave the calculations. Yeah, let's not let them auto-populate. Let's take things one thing at a time, right? Now, again, you guys can be given these values in a table. Other times you might have to plug it in your calculator and work them out, right? Now, again, 2 or 3 decimal places is sufficient. Past that, you don't have to do, right? So maybe what we could do is we could do, let's do a rounding now. We're gonna round this to 3 decimal places, right? Okay, right. So 40,000, right? Okay. So in the next year, we're gonna do is gonna be 1.1, right, to the minus 2, right? And 1.1 to the minus 3, and 1.1 to the minus 4, right? So these are the present value interest factors, the approximate ones. Again, you don't need a whole set of decimal places to be to be properly accurate, right? Sometimes the values are going to be off by like $100, a few hundred, right? And in the context of like $40,000, a couple $100 is like immaterial, right? $400 is 1%, right? 1% of something is immaterial. What immaterial means is that it will not be sufficient or significant enough to really influence decisions made, right? If this thing were to change to the actual accurate one, right? Okay, so what we then do is we multiply the net cash flow by the present value interest factor. Oh, sorry. Let me take these off. Right. So 40,000 by 0.909, right? So again, I am actually just using 0.909. If you are using the actual exact value, it's going to be a little different, right? I'll show you by how much, right? So, right. Oh, hold on. Yeah, okay. Forget that. Right. 40,000 by 0.826 is that. Then 40,000 by 0.751, that's going to be a little more than 30,000. And then 40,000 by 683 will give us 27,320. Right. Now, we don't actually need a total, to be honest, right? But a total will actually help us to see if we pay back for the whole thing or not, right? The initial outlay was 100,000, right? So we know right away from the sum of the present values, the discounted cash flows, right? The discounted future cash flows, that we get back 126 and a little more, and we only put out 100,000. Now, these two values, all these values here are comparable to this one and to each other. They're all in the same time frame and have the same purchasing power. Now, what we're trying to do is figure out how long does this project take to pay back for itself. So what we do is we simply subtract each amount earned every year until we have nothing, no balance left, right? So how this is going to look is going to look like this. So I'm going to start with the 100,000 and I'm going to minus this figure here. Right, so I have 63,640 left. In the next year, I earn 33,040, so I'm going to have about 30,600 left. Right, cool. The next year, I get back $30,040. So I have like 560, which you could almost ignore, right? That's not even $1,000, right? It's not even $600, right? So the next year, I get back $27,000 and change, right? So in the first month of the next year, it pays back for itself, right? So you could round this off to 3 years, right? So the project pays back for itself in 3 years, right? If you want to see the precise value and the actual kind of working that we would have to do, I'm going to put it in here, right? Right, so you take your 3 years, and then what you would do is you would take the balance left at the start of the 4th year, divided by the inflow. I know I have 27,321, right? Sorry. Oh, just let me just answer Haley. Yeah, I know. Yeah, people in different crash courses and things. Okay, no problem. Yeah. Right. So yeah, so that's basically it, right? So what we do once again is you set it up like an NPV thing from yesterday. You have the annual net cash flow. Now I used the same figure just for the ease of calculation, right? Of course, it could be this is what you call even cash flows. You can very well have uneven cash flows. So, hey Pookie, how you doing? Yeah. Right. So you multiply these by the interest factors. Again, sometimes in some questions it'll give you a table with the interest factors. Other times you'll have to calculate it, and now you know how to do it. All right. So when you multiply A by B, you get the present value, right? So you do that for how many ever years, and then that's the discounted part. Now we have to apply the payback part. So you're going to start with your initial outlay, your initial investment, right? And you subtract how much money comes in each year as you go along, right? So 100 minus that is 63,640, minus that is 30,006, minus that is 560. So the project practically pays back for itself at the end of 3 years using discounted cash flows, right? And even when if it wanted to be very precise, you would take the amount outstanding, you take the amount outstanding at the start of the final year when it's going to be fully paid back, put it over the total amount, right? And that's going to give you, right? So let me show you, right? So equal to 560 divided by 27,320, right? Sorry. Yeah, so 0.02 of a year. That's 2% of a year, right? Multiply by 365. So in the first week, after the first week, the project pays back for itself. Of course, that's based on the assumption that the cash flows from the project are earned evenly throughout the course of the year. Right? That mightn't always be a correct assumption, but it's what we call a simplifying assumption to facilitate the modeling, the use of the model, right? The mathematical model. Right? Of course, when things get a little more complicated as you go a bit higher up in accounting, right, or financial analysis or financial management, right, you learn how to deal with those things there. But for our stage right now, right, and even professional stages, right, they use this as at least a starting point, I believe, right? But at least it's to get like your foot, your brain in the door. Okay, cool. So, ladies and gents, can I just get a quick G in the chat if you're good with what we've done there? If you need me to re-explain, please give me an R. If you have any specific questions, you're very welcome to ask those as well. Yeah, 1, 2, 3, 4, 5. Yeah, I think that's 7 and 6. Okay, there you go. All right, so what I want to do, I want to give you guys one to try. Okay, so you have a El Taco Inc. All right, so what I'll do is I'll send a picture of this in the chat, of the question itself. One second, I'll just crop out the little edges there. Right. So it says El Taco Inc. is considering remodeling its restaurants at a cost of $190,000 per location. Sorry, one second. Just me nitpicking on something here. I'll strip it out. But yeah, I'd like to see the grid line at the edge. As though like it to overlap. Anyhow, yeah. That's again just me being kind of stupid. Hold on, does this do crops? No, it doesn't. Okay, cool. Right. So El Taco Inc. Right. So the company believes that increased patronage will result over the next 5 years. In other words, if they remodel the restaurants, they'll get more customers in over the next 5 years, creating the following additional net cash flows: 70,000, 60,000, 50,000, 30,000, 10,000. Okay. So as you can see, you have uneven cash flows. That's fine. Oh yeah, by the way, don't worry yet about the profitability index. That's on the next thing. We'll jump back here and I'll show you how to deal. I'll show you how to deal with it, and we'll jump back here to practice. Right? Okay. So we have 5 future cash flows. So it says Altaka uses the NPV and these are okay, right? So we're not going to be doing NPV. We're going to be doing discounted payback. All right. So your initial investment is 190. Your in future inflows, your annual future net cash flows are these items here, and your rate of return, your discount rate is 12%. Sorry. Yeah. So what I would like you to do is to use. You could use this layout, or if you know of a different layout that you already know and you already like, you're very welcome to use that. Right. But what I want you to do is basically what I did just now. Right. You're gonna put the cash flows here. You're gonna get your interest factors. Right. If you want me to put the interest factors, let me know. Right. If you want to do that, just comment IF. Just put IF for interest factors. Right. I'll put the interest factors here. So you just have to copy them and multiply going across. You'll get the present values here, and then you'll subtract the present value as you go down and see how much is left. And at some point in time, you'll get to a point where you have a smaller amount than the cash inflow coming in next year, and you'll have to work out how long it takes. Right? But if you want to, of course, practice working out the interest factors, perfectly fine. Again, you could round off to 1 decimal. Sorry, 3. You round off to 3 decimal places. course, if you have any questions, feel free to ask. If you have any, if you want to send pics of your work as you go along, that's welcome. Please send thing. All right, I want to start populating some figures here, right? If you're still working, that's perfectly fine. So 70,000, 60,000, 80,000, and then 10,000. Oops, that's not 10, that's 100. Yeah. So we see decreasing annual net cash flow. So clearly, they expect they expect increased patronage to decrease. Like if it's new in the first year, so people come in, they still a customer in the second and third year. By the fourth, they're like, well, it's the same place. So they clearly have to start do more remodeling after 4 years. Anyhow, okay. So this present value interest factor, of course, is equal to So 1 plus the interest rate, which I lock, right? And then raised to the power of, well, the negative in negative number of years, right? So it's 12%. So hope you didn't use 10. If you use 10, let me know. It's not going to be correct, but I'll still show you the figure, right? So when we pull that down now, we get, oh, wait, hold on. I wanted to really control that. Right, so 0.7, right, so 0.893797712. Good. Maybe I should round that. Yeah, to 3 digits. And let's pull that down as well. Okay, cool. So now what we're going to do is multiply each of these by the corresponding PVIF. So 70 by 0.893 and everything. Okay, hold on, just now. Okay, right. So you have these figures here. Okay, lovely. So this project doesn't pay back for itself, right? If you take these figures here and you add them up going down, you get 170. Let's say 171 on a stretch, right? You outlaid 190. So this project doesn't have a payback period, right? Maybe if there was another, actually no. If you look at it, you still have to get 20,000 in today's dollars, right? So that's interesting. So what we could do is we could actually, so in the next year would be the 6th year, right? So if you wanted to find out how much money, what the cash flow in the 6th year would be, that you would need to actually just pay it off, we could take this here and multiply it by 1 plus 6. Sorry, 1 plus the interest rate, yeah, raised to the power 6. So you need 38,000 to come in again. Let's see. All right, so if we did like a year 6, now this is just me playing around, right? So 38, this is 38,000, right? 38,000. Yeah, so you see, yeah, if you had a little more than 38,000, you could almost finish payback for it. See 189,946, so it's close enough, right? Okay, sorry, that was just me being a little extra. You didn't have to do that, but sometimes it's just interesting to know. Okay, well, how much extra would I need? All right, okay. Can I get a quick G in the chat if you guys got that? That there's no payback period for this. Sorry, no discounted payback period for this particular project. All right, cool. All right, the next. Anybody else who didn't answer? If it is a move too fast, I didn't give you enough time, let me know. All right, I have to keep forgetting to check in with that. Okay, cool. All right, no problems. All right, lovely. Okay, so the next thing I want to talk about is the profitability index. What I want to do, let me just actually zoom in here a little bit, right? Wait, hold on. I was supposed to send a picture. Yeah. That's that piece. Right. So the profitability index now. Right. So the profitability index is the sum of the present value of the future net cash flows divided by the initial investment and expressed as a percentage, right? So basically, yeah, add, so okay, the information here, if you notice, is actually the same. Initial investment of 100,000, you're getting 40,000 annual net cash flow per year for 4 years at 10%. So it's actually the same information as in the first question. So all we're doing is we have to add up the cash flows and then put this over that. All right. So we're expressing the sum of the discounted annual net cash flows, that sum as a percentage of the initial outlay. All right. So let me show it here, right? So stability index. All right, so it's like the initial outlay is the 100% figure. So you want to get back more than 100% of what you put out. So that's all this is showing, right? So if you get back more than 100%, it means, hey, I got back more than I put out, great, no problem, right? And in terms of present value, so this is discounted. No, sorry, this is present. Oh yeah, this is some of the present value, so it's discounted. All right, so we're gonna put 40,000 there for all four. For this one, it's gonna be equal to okay. So hold on. 1 plus this, let's lock that cell. Then raise to the negative of this item here. Sorry, I was supposed to round. Yeah, so it changes ever so slightly, right? Okay, cool. So what we're seeing here, right, is you have the same figures from the example before. So you technically don't have to write this over. You can just write the formula down if you want, right? So again, what we're doing is we're taking the future cash flows, we applying the appropriate discount rate, and then we adding up the present values. And then we're going to express that present value, the sum of that present value, those present values, as a percentage of the initial outlay. Right? I have some notes here, I believe. Right. Right. So what we can see here is we get back, yeah, 126,760 after putting out this item here. 100,000. So that's 126.76% or 0.8%. So we get back 126% of what we put out. So projects with values of 100% and above are accepted, and projects with values less than 100% are rejected. Again, from a purely financial perspective, right? In non-financial stuff, we didn't really get into that much. We should explore it. Right. So again, this is the same exact example and figures as the first one we did here, right? Right. So you see same 40,000, same 10%, same 4 years, same discounted cash flows, same 176, 126.76, right? So we're just putting that over the initial outlay and expressing it as a percentage to show we're expressing that figure, which is the sum of the present value of the future cash flows associated with the project as a percentage of the initial outlay. So we're comparing present value, right, money with the same purchasing power with with respect to the initial outlay. Sorry, I'm a little tired, right? And then yes, so if we get back more than 100%, we're great, right? So if you're analyzing multiple projects from a purely financial perspective, you'll take the one with the biggest profitability index, right? So what I want you to do is we're going to pop back here now, and I want you to calculate the profitability index for this project, which will simply be this over 190 and then multiply by 100, right? So I'll take you a minute or two to organize that. The Dark Knight. What are you doing the Dark Knight? Well, all right. So let's do it. All right. So 170, 680. 190 is approximately 89, a little more percent. Oh, you're just watching one of my videos. Oh, okay, cool. Which video was that? Tech one or POA one? Maths or accounts or hard maths? Okay, cool. So Google Meet, my Cape class. If you guys are good with that figure, and the profitability index is a concept, just give me a quick Genie chat. If you have any questions, you want me to re-explain, give me an R. I kind of wish we could have class tomorrow, but yeah, that's not a possibility, unfortunately. All right, cool. 1, 2, 3, 4, 5. Okay, that's everybody. Lovely. Okay, so I've given you another item to work out here. Whoops, I was supposed to hide that. I kind of gave away the answer there. All right, so what I did here, we have Summer Recreation Inc. uses a payback method to evaluate major new attractions for its amusement parks. Company policy is to accept projects that have a payback period of 3 years or less. The firm has been looking at a $1 million ride called the Whiplash for its Tennessee facility. The ride has a 5-year service life and is expected to generate the following additional cash inflow. So we have it here. Okay, now we're using a rate of 10% because the question didn't give me one. Now, what I want you to do is to calculate the discounted payback period and the profitability index. All right. So I I gave you a little help out here. I did the what you call it, the interest factors. All right, let me just round them off. Right. Okay. So yeah. So you're just gonna plug your cash inflows there, multiply them by the interest factors, get the present values, add them up, right? And you can put it over the 1 million to find the index. But of course, I still do want the payback period, right? Just a bit of a spoiler, as you probably saw, we don't actually get a payback period. Yes, Aaliyah, talk to me. What's up? So, if you repeat do or do? Sorry, do or don't what? You were saying about the payback period. Oh yeah, no, we don't get one. Basically, what happens is when you discount the figures and you add them up, you don't get enough. You don't even get back to the million. So I just all I wanted to do is just to practice doing the multiplication and the subtraction here. Right. I wonder if I could actually give you a figure that'll give you a payback, boy. Because we just saw one that didn't have a payback, right? So maybe we should have one with a payback. Okay, hold on, give me a second. All right, so you know what we're gonna do? We're gonna replace this 100,000 here with let me see something. Okay, yeah. No, one sec. All right. Nope. All right. All right. Let's do times. All right, cool. And then what we'll do is we'll also take out the outline. Yeah, okay. So what we'll do is I'll modify the question, right? Oh, I should also shrink it down a little bit. Looks about right. Okay, cool. So yeah, so we replace that. Oh, I guess it could be a bit bigger. Doing a dollar sign. All right. 150. Oh, right. And let's get rid of the background too. Yeah. No fill. Oh, did I? What did I do? Oh, no, no. I need a fill. Oh, my bad. Yeah. What? Oh, I want to. Okay. Yeah. So don't use the 100,000 figure they have. Use the 150 I'm giving you, right? Because, yeah, if you use the 100,000, you don't get a payback period. You actually get less than the 1 million. So the 150 should cover it. I should really have checked the calculation before. Why? Sorry, no, not Yola. Right. So interestingly enough, after this, we have an IRR, the IRR to learn about. Although that one is, I don't think they've ever brought it. I think maybe once because it's an involved calculation. I mean, if you remember your what you call it formula offhand, then that's great. But it's a little tricky. Again, not trying to frighten you. Oh, that's where I was. Right, so it's gonna start populating here. So 400,000, 300,000. That's a city. 50, 200, and then 150. Right. Mhm. Oh, right. Okay, good. Yeah, yeah, yeah. So you definitely get a payback period. Um, Profitability index, right? So I have to change these figures here. Right. So I'm gonna change this to full screen, right? So 101, excuse. Oh, 1.03%. So sorry, no, 103%, right? So 102.89. Right. So it barely passes. It just about makes it, right? Okay, cool. So what we're gonna do here now, and again, if you wanted the discounted payback, what we would do is we would take this over that, right? What? How we get? Oh, right. 0.69 years. So it'll be 4.69 years in total. Right? If you want to multiply by 12, this multiplied by 12 will give us 8 months. A little more than 8 months. So 4 years and 8 months. Right. So 4 years, and well, 4.69 years or 4.7 years, and then for 4 years and 8 months. And the profitability index is this, right? Again, given the modified figure for the last year of 150 instead of 100,000. Right? The 100,000 makes a big difference. Right? We don't even get a payback period. 997 doesn't even make 1 million. So yeah. Okay. Can I get a quick G if you guys are good with this question? If you need me to re-explain anything, that's not a problem. Let me know. So let's send you all the question. Solution, right? All right, cool. All right, guys. So we're going to talk now about the IRR. IRR is the internal rate of return, sometimes called the break-even rate or the hurdle rate. What that means is that it is the rate, the discount rate or rate of return that gives an NPV of 0, right? So this is the discount rate that gives an NPV of 0 for a project, right? I tried quite unsuccessfully a couple of times to figure out a formula, and then this formula happened to find me. I think it came from a student, I believe. I can't remember exactly. Or maybe it was Google. I feel like it was one of the FJC girls back in like 2012 or 2014 or something. I don't know. Right? As you can see, the formula is a little involved, right? So basically, you have one discount rate that gives a positive NPV, right? Which we'll call NPV1. Then we have a discount rate that's slightly higher, and that one gives a negative NPV, right? We'll call that one NPV2. Okay. Now, what we're doing here is I'm using the same information from the initial example and from the that I used for the other one just now as well, right? So the same 100,000 outlay, annual net cash flows of 40,000 per year over 4 years, and I have two rates, 21% and 22%, right? So ideally, you want these rates to be 1% apart, Ideally, right? The closer they are together, the more accurate the answer will be, I believe, right? So what you want is that it's going to be basically R1, so the smaller rate, right? So the smaller rate gives you the bigger NPV. The larger the rate gets, the smaller the NPV gets until it goes to zero, right? When the rate rises, NPV goes down. When the rate goes down, NPV goes up. Okay, so they have an inverse relationship. So you basically want, we know that R1 gives us a positive NPV, so we want it, but R2 gives a negative. So the rate that gives us a zero NPV, or close to it, as close as possible, lies between them. Not exactly between them, as far as we know, right? Or that we don't know, right? So what we have to do is we want to work out the little amount you have to add on to the smaller of the two rates to carry it up sufficiently to make the NPV zero. And this is the formula here, right? It's NPV, so the positive NPV over the difference between the two NPVs. The difference between the two? Hold on, let me see. Oh no, it's all right. So it's basically the sum of the values, the absolute values. Okay, cool. All right. So right. So even though it's NPV1 minus NPV2, right? It's not the difference between the two NPVs. It's actually the sum of the what we call the absolute values. So let me explain what that means, right? So let me actually put a split here, right? Okay, so for the first rate, right? The first rate of 21%, right? We're gonna put again 40,000 here for all of them, right? So for the discount rate of 21%, 40,000, you're gonna get NPV of 1,618. So that's a positive NPV. When you use 22%, we get a negative NPV of 254, right? So what we do is, again, you take your 1618 and you add it to your 254. So you minus and a minus, which makes it a plus, right? So it's 1618, the positive NPV, over the sum of the what we call the absolute values of the two NPVs, right? So you'll ignore the fact that it's negative. You're just going to add it to the positive NPV. And you're going to multiply that by the difference in percentages between the the rate that gave the positive NPV and the rate that gave the negative NPV. In this case, it's just like a 1% differential, right? Again, I know this is a lot. Sorry. Phantom, how much marks do I have to get in the paper to get this issue? Phantom FF, nobody knows except CSEC. CSEC has never released the grade bands. They've never released the percentages for any of the years. So it's a goddamn mystery. All right. So I'm sorry I couldn't be of more help. But your best bet is to get as many marks as possible in as many questions as possible in as many papers as possible. I know that sounds very generic and very unhelpful, but that's the truth. Sorry. Yeah. All right, guys. So as you see, it's 21.86%. So what I want to do is this. I'll copy this and I'll put it here, right? What we'll do 21.86% here. Um, right, so 21.86. 186. Now this is not something you have to do. You don't have to double check it. 21, yeah, 86. This is just me being illustrative. Right? And as you, hold on, did I round it off? Let me try rounding it off and see if that helps. But as you can see, the NPV is $4, right? That's close enough to zero. Whoop! Look at that. Exactly zero. Right? So actually, I use a yellow and a green, so maybe I should use a different, a more striking color for this, right? Red, is red good? Wait, what did I just do? Yeah. So with the IRR, the discount rate of 21.86%, rounded off to 3 decimal places, I got the exact value of the initial outlay. I'm not even sure how that happened, to be honest, but it just shows, it goes to show that the formula really works, right? Right? IRR, right? Yeah, sorry, NPV. Yeah, right. So once again, let me just recap this this thing. So the IRR is the internal rate of return, also called the break-even rate or the hurdle rate. It is the rate of return, the interest rate or discount rate rather, that gives you an NPV of 0 for a project. So it's like I said, if you get back 0 for the NPV, it means that the present value of the future cash flows, the sum of the present value of the future cash flows, is equal to your initial outlay. So you got back exactly what you put out. Like, remember when we did break-even analysis, that's what it said, right? That's what it meant. A profit of 0. Here we're not talking about profit per se, we're talking about surplus cash. So in this particular question, right? So like I said, this here is the formula, right? So we have, like I said, about 4 variables here. You have 2 interest rates. You have an interest rate that gives you a positive NPV. Well, let me actually split the screen again, right? Yeah, you have R1, which gives the positive NPV, as you can see here. So the same 40,000 per year discounted at 21% for 4 years. Sorry, let me just, I want to round these as well. Right? So we get a 1600 here. Right? So 1600, right? Cool. And then, so the 21% gives me a positive NPV. The 22%, which is just above it, right? Again, I'm going to round. So this is going to actually affect my calculation somewhat. Yeah? But we'll just ignore any of the. Oh, right. Right. So I get a negative NPV at 240. Right. Now, again, this wasn't far off from the other values. It was 16, 18, and minus 254. So it was $18 on one side and 14 on the next side. So a $4. So remember when I did it initially here, I got a $4 differential, right? A $4 NPV, right? So that's why. Let me zoom out a little bit. Right. Okay. One sec. Let me just see what picture. Okay. So I sent the picture. Right. Sorry. Right. So, like I said, the formula is a little tricky to remember. It's not a very simple formula, but again, if you spend enough time learning something, you will remember it. You write it out, you practice some questions with it. The trickiest part here would be getting the NPVs, the positive NPV and the negative NPV. To me, they would have to give you those things. So that's why they hardly test IRR. But it's on the syllabus, so I have to show you it, right? So yeah, so like I said, the IRR has this formula where you take the smaller interest rate that gives the positive NPV, and you have a slightly bigger interest rate that gives a negative NPV. So you find the difference between those rates and you're multiplying by this figure here. Now what that figure is it's essentially the sum of the what I call the absolute values of the NPVs, right? So whether they're positive or negative, we're ignoring that. We're just going to take the absolute value, right? So basically, imagining that they're both positive and you added them together, right? So I know I have a negative sign here, but that's because this second NPV is negative and you're minusing a negative value, which of course is tantamount to adding it together, right? So one sec, sorry, and it was supposed to be 1600 and 240, right? Okay, so let me change that to 1600 and plain old negative 240, right? I fit, no, I don't want to fit that whole thing. So I'll just put it here. Drop the top a little bit, bring in the left side, bring in the right side. Yeah, okay. Right, so, I mean, if you want to check it, I can check it for you. Yeah? So, right. Hold on, why I have one? It This should be 0.21. Oh no, I already have it. I just didn't. Right, I know I had it. Right, sorry, let me just take off that last thing because it's going to look strange that it has just the 1 as opposed to the 0.21. Sorry. I know something was odd because when I was highlighting it, I knew it wasn't going all the way. Right, so let's crop that side. So less of a... Right, so like I was saying, so you take your smaller percentage, and we're just trying to find the small amount by which we have to increase it. Well, small or not small, the amount by which we have to increase it, so that when we plug it into the NPV calculation, we get an NPV of 0. All right, so yeah, so 1600, my bad. Right, so it's the 1600 over the 1840 multiplied by 0.0. Actually, I have a nice calculator here. I got a new one a couple months ago. I barely use it because I just accustomed using Excel. All right, okay, so then I'm gonna get my fraction. Right, so hold on, go in front. So I have 0.21 plus, oh crap, yeah, back 0.21. Where did I go? Well, what is okay? Okay, sorry, my bad. 0.21, right? So hold on, I need to go on the outside here and put a bracket. Okay, cool. That's 1600 over 1600 minus weight name 240. Right. I'm gonna come on the outside here. I'm gonna multiply by 0.22 minus 0.21. Close that bracket, close that bracket. Right. I have 500 over 2300. Lord have mercy. Okay, good. How do I convert that now? Just here, equal to 500 divided by 2300. Oh, sorry, not 5. So 503. 503. 503. That's a weird one, man. See, 21.87. So even if I were to change this to 21.87, oh no, it does make a difference. Yeah, okay, cool. Yeah, so 21.86 was the nail on the head, boy. I've never gotten it to be exact. I don't know how it happened to do that this time. Right, cool. Right. Okay. Yeah. So, like I say, I don't know why I stammering so. Like I said, I know that they hardly ever bring this, if at all, maybe once. As you can see, it's quite an involved calculation, right? So what I want to do is I want to give you guys one to try because, I mean, yeah, and then actually that'll be it for class. We don't actually have to go all the way to 6:30, right? So 27.9. Actually, look at that. I didn't even do that piece. Hold on. Usher Corporation is considering the purchase of a conveyor system that costs $92,133. Okay. The system has a 15-year life and will result in net cash inflows of $15,000 per year. Okay. Assume straight line depreciation, no residual value, no income taxes, and round calculations to the nearest dollar. So they want the system's NPV. If they have a 12% rate of return, they want the internal rate of return, the payback period, and the ARR. Okay, here what to do. We're doing the payback period. So that's the non-discounted payback period. So that's the simple and straightforward payback period, and then the ARR. Right, we'll do those two quickly first. Then we'll do the what you call it, the NPV. We'll do a combination NPV and discounted payback. All right. Now it's a 15-year life. So actually, that's gonna if it's a 15-year life, then you're better off using the formula from yesterday. Do you remember the formula from yesterday for the all right, here what to do. Do the payback period, do the ARR. I'll show you how to handle a question. Now, is it likely that CAPE will bring a 15-year life for you? No. All right. We could change it to 5. if you all want. But I want to show you how you could deal with it just in the event of, right? I really and truly, I think these calculators could do that kind of stuff. I just don't know how. I just kind of like to use my brain and Excel and simple calculators with that. I shouldn't be really resistant to stuff like this. I don't know what that means. All right, cool. Catalog, function analysis, probability numerical, handle code, what hyperbolic trig, engineering, conclusions, other, i.e. root inverse. Is that a 2? Yeah. Oh, Barry. Oh, Risham. Oh, vibes. Right, so remember for the payback period, hold on. Huh? Matrix. Math box. Real things in this boy. Started. Oh, they give you. Oh, it's a thing. Okay, cool. Sorry. Set off. Leave it, I guess. So. Shadow fell asleep around 4. Right, so he's down for 2 hours. Wake him up now. It's not a big deal. He's take 3 hour naps. Right, so for the payback period, because it's annual net cash flow is the same, we just taking the 92,133 and dividing by the 15. Huh? Right, so it's about 6.14 years, so a little more than 6 years, right? Not even 6 years. Hold on. Yeah. So maybe about 6 years and 2 months at most. Right. For the ARR, we need profit. So we have to convert the 15,000 to profit. Now, how do we do that? We do that using depreciation. Cash inflows of 15,000. Now, check it. How do we get depreciation? Well, the cost is 92,133, and we're using it over 15 years, right? So if you take 92,133 and divide, hold on, let me actually take all this, right? So if we take the cost, 92,133, and we divide it by the useful life, what that gives us is the annual rate of depreciation. Cool. Right. So 6140. So what we could then do, right? Hold on, let me actually pull this up a little further so we have more. Right. We could then take the 15,000 per year, take away the depreciation. That'll give us the increase in profit per year. So we're going to take that over the 92,133, right? Right? Yeah, so there you go. So 88.58 over that gives us about 9% per year, 9.6% per year. Right. Okay, so like I said, there was a formula from yesterday. So here what I'm going to do. I'm going to put up the formula. If you think you want to use it, cool. If you don't want to use it, and you just want me to do the calculation, no problem, right? So this is the formula here. Do I have it? Do I have it as a thing? Self? No? Okay. All right. So it is this formula here, right? So you could put 1 plus r over 100. It just gets kind of messy when you do it like that. Right? When I learn with the r is already a percentage, right? So that by r over 100, right? Right. So yeah, so you'll take your one, and what is the formula? What is our thing? Our thing is 12%, right? So it'll be like 1.12 to the power 15 minus 1 over 1.12 to the power 15 by 0.12. Right? So plug it up and see where you get now. Or again, if you just want to wait a minute and let me just put up the answer, we could do that too. Right? Honestly, yeah, NP, this topic is actually my favorite on the syllabus because of the maths in it. I do like all the topics, most of the topics on the syllabus, even variance. I know my last session on variance was a little lackluster. I wasn't feeling 100% that day. I do apologize for that. Wow, yeah. So all right, cool. So let's knock this out and call it a day, shall we? All right. So right. So again, like I was saying, so let's kind of zoom in right around here, shall we? Right. So like I said, it was 1.12 because it was 12% to the power 15 and minus 1 over 1.12 to the 15 by 0.12. So you're multiplying that by the annual cash flow. That's going to give us the sum of the future cash flow, present value of the sum of the future cash flows. You minus the initial outlay and you get a positive NPV. All right. Okay. Yeah. Yeah. Don't worry with the discounted payback. That's not gonna work out. Yeah. Okay. Yeah, guys. So, like I was saying, we could probably stop there, to be honest. Right now, again, next week on the Tuesday. Now, I don't know what's going to crop up between today and Tuesday with respect to that funeral. I don't think we have an active part in it because of whatever reasons, right? In terms of planning and prepping and that kind of stuff, having to go and get things. I think we are isolated from that, but I don't know. I know the funeral is here on the Wednesday morning. I don't know that I'll be able to do anything the Wednesday afternoon, but I know I have class here, the last day from Form 5's, the official last day of regular class, and then, well, we binge in POE down the line, right? So I'm going to try to put you all on the 1st of May. Barring that, again, I have some free slots the rest of the days. I mean, Form 5s might ask for those things, but I want to give you all time as well, because the next week, I don't think I'm able to. All right? Unfortunately, right? That's just how the timetable ended up this year. Kind of sucks, right? Now, of course, so yeah, I figure you'll all be studying for Caribbean studies here. And, well, whoever has Caribbean, and then Caribbean is here. So even if you say, well, let's do a 1 to 3 on that day, you know, because normally I like to work the evening before and right up to the exam, but that's just not how things run this year. But then next week is the multiple choice. So again, what I could try to do is I'll see if Mishka, my assistant, could handle all the AdMath stuff. She's been basically running the AdMath class since December, right? December, January, February, March, April, 5 months. I mean, I give her the work to do, right? And she just does it with them, and she does a pretty good job of explaining and checking with them. The parents seem to be very happy, so I'm like, okay, cool, you know. Yeah, so maybe we could talk about some multiple choice sessions there, but again, it depends on what you all have going on here. And yeah, I'll kick up my Form 4s here. They're gonna have more time after you guys go, so their exams are somewhere around here, so we have enough time to deal with that. And I'll probably bring them in for extra days, if anything, just to do makeup sessions or whatever the case is. All right. Anyhow, folks, that's how fast 8 months passes, eh? Because we're here since September, October, November, December, January, February, March, April, right? So we've done the vast majority of the syllabus. Maybe 1 or 2 things kind of got lost in like hazardous materials, but I think I sent something that AI generated. I'll check ChatGPT. What I sent was done by Microsoft's Copilot. But I at the start of this month, I actually did a ChatGPT subscription for the premium. So I'll see what ChatGPT says and cross-check it with what I could find on Google. So if I find anything different, I'll send it, right? Anyhow, so yeah, so that's the plan, ladies and gents. We will pick back up on Tuesday. Right. We'll pick back up on Tuesday for a full day of just questions from paper 2, right? There may be 1 or 2 extra people. Not many people responded to the promo I put out for it, like 3 people. 1 paid long time, but that was when it was like 6 days of double sessions. So I had to send her back money, as a matter of fact. Yeah. All right. So we pick up on Tuesday, guys, and then we have Thursday again, and then that's it. All right, guys. So have a good evening. If anybody has any questions, please feel free to reach out. All right. Other than that, I'll see you guys next time. Bye.